The recent development in emerging markets highlights a structural shift that is not immediately visible in price alone. While the index remains relatively stable year-to-date at roughly -1.9%, underlying market conditions have deteriorated meaningfully. Both short and mid-term market health indicators have now fallen below the key 50 threshold, signaling that negative signals are beginning to dominate across trend breadth and sentiment. This is exactly where a structured framework adds value. Markets rarely move directly from strong uptrends into sustained declines. Instead, they transition through a sequence of weakening internal conditions that price alone often fails to capture in real time. What initially appears as a constructive consolidation has now evolved into a structurally weaker environment. The alignment between time horizons has turned negative, a configuration that historically marks the point where downside risks begin to outweigh upside potential. Importantly, this is not about predicting markets. It is about classifying the current environment and aligning with it. The previous constructive pause has transitioned into a strong downtrend regime. In such phases, the behavior of markets changes. Participation deteriorates, trends lose stability, and rebounds become shorter and less reliable. What worked in an uptrend stops working once the underlying structure weakens. For investors, the implication is clear. The objective is not to catch turning points, but to avoid being positioned for the wrong regime. Risk management becomes more important than return maximization. Until market health stabilizes and moves back above key thresholds, the focus should remain on capital preservation rather than trying to time a bottom. Do you want to follow the market health indicator for the emerging market ETF and 27 other global markets and sectors? Check out our research at WallStreetCourier.com and make sure to follow our channel for more market insights.